Okay, welcome to another episode of Regulation Central, provided by Polunsky, Beitel, and Green, the prominent law firm for residential mortgage lenders. For nearly 50 years, Polunsky, Beitel, and Green supported residential mortgage lenders. They understand them better than anyone. If you have a need for a legal partner to prepare or review mortgage closing documents that are compliant, properly risk adjusted, give them a visit at mortgagelaw.com. And with that, I'm going to introduce my panelists, Brian Levy and Marty Green. Welcome, gentlemen, and we're going to have an exciting conversation. Another month of mix-up in the crazy mortgage industry. We've seen so many changes. It seems like there are just a never-ending feed of new mortgage information hitting the street. So, first topic for today is
Wait a
going to...
second, Matt.
Oh, yes,
Matt,
go ahead.
before we go, I guess I didn't realize, Marty, you guys have the website mortgagelaw.com.
Yes, we
Like, who
do.
did you arm wrestle to get that? That's awesome.
Yeah, we had we that happened a long time ago, but yes, there was less competition then than now.
Brian, when you've been in business for 50 years, you got the first crack at early domain names.
I'm impressed. They were on top of that internet thing before anybody knew what it was.
Yes. It was X.com was purchased and then mortgagelaw.com was purchased.
Yeah, that's good.
All right.
Sorry.
So jumping in. The hot buzz is about the latest acquisition. We had another big dollar acquisition. So Rocket Mortgage, the previous Quicken Loans, has purchased Redfin. So the first thing I really want to dive in here, and I'm going to ask Brian to go first, is one, let's look at a summary of the acquisition. Two, I kind of want to dig into this concept of a one-stop shop. Has it worked in the past? We've seen different people try it. So what's going on? What did you hear about the acquisition? And let's dig a little deeper.
Well, I didn't hear anything that isn't publicly available, but it's pretty apparent that there's a couple of cross currents that are coming together with this. The idea of the one-stop shop, affiliated businesses, they've been around for a long, long time. In fact, I was chairman of this organization, Respro, when the strategy that my bank had on the retail mortgage lending side, ventures with realtors and builders and even other financial institutions. So the joint venture world, affiliated business world is very familiar to me. Why I think it's, when you see a merger like this, an acquisition, Rocket and Redfin, why is that happening today? I think there's a couple of things. One is all the changes happening with real estate, the NAR, all of their listing issues, the MLS. There's a lot of change afoot in that business, and I think it's time to look at some new business models and new opportunities. The other is, I think it's pretty obvious that RESPA case against Rocket got dropped with prejudice, meaning that they can't refile it. And so I think that it sort of was a ticket to say, okay, if you want to create these opportunities, this is the way to do it. And it's certainly, if you follow the requirements of affiliated business arrangements, you can do it legally and hopefully not get in the crosshairs of the next regulator or a consumer action.
Yeah, I agree. Definitely with proper disclosure, it opens up a lot of windows. Marty, you have any commentary? And then I'll give you guys some more insight from my perspective as a lender.
Sure, I'm anxious to hear what, as a lender, you think about it, but just sort of understanding that, the shopping for homes has sort of shifted in the last several years with the internet, where before you started with a realtor and they took you around to homes, and that was the first time you saw them. But what we know from studies show like 60 or 70% of people actually start their search online now. And so I think Rocket is kind of recognizing that early entry point, and that Redfin is an avenue for people to start that search. And so they have the ability to then potentially refer a realtor and probably a Rocket affiliated realtor or Redfin affiliated realtor to it, and to start that process. And then again, in the same ecosystem be able to offer them a mortgage. I think the watch out from a consumer standpoint, I guess, is you may be getting low cost providers, but also low service providers in both of those instances. And if you have one of those being a low cost provider, and then the other being more full service, that might blend away because you get greater experience perhaps all around in terms of that, where you get some blend of service and price that works for you. But if you have both of them without, being high service, that could be a real problem, I think, particularly for first-time home buyers who need more coaching in the process, need to understand it better rather than just using the low-cost provider. So I think that's the concern I would have just looking at it, but I don't see any, as Brian said, any real roadblocks to it based upon the affiliated business arrangements, the way they work. I just think that there could be a service component that's really going to be suffering as part of that. And so that'll be one to watch with respect to it. What's your reaction to it as a lender?
Oh, I have so many layers of the onion to peel back here. So one, I agree, usually I take a regulatory angle, but being that there's common ownership, I think, that's what makes the regulatory angle very easy, if you will, in this regard, that it can be done via disclosure. When I start looking at the history of both these companies is where I will say the first layer of my onion is we look at Rocket Mortgage and we look at Redfin. They're both relative disruptors in the space over the past decade. Rocket Mortgage with the click a button, get a mortgage, and obtainably one of the first downloadable apps that really kind of changed the online mortgage marketplace and changed consumer direct mortgage. There were many players that attempted it before that in the early 2000s, but Rocket was the first that we went mainstream. They were the first that we saw a Super Bowl commercial with. They were the first major consumer direct player. And then Redfin was one of the first players that we saw actually survive what seems to be the quote unquote discount real estate model. In the decades before that, we saw companies like Foxtons, and then we saw this emergence of companies like Purple Bricks and all these other in the 2010s discount real estate brokers that never really seemed to make it. So these are two companies that survived. Now, to your point, Marty, what I really find interesting is your commentary on potential lack of service, potential doubling this quote unquote consumer direct or discount brokerage model, that somebody's got to quarterback the transaction. And we know Redfin's known for those salary-based agents, maybe lower compensation models.
Hey,
Rocket
Matt,
Mortgage. Yes, go ahead.
before
Yeah.
before you sort of get into the what's best for consumer kind of
Yeah.
question, one of the really important things to realize about this transaction is what you just talked about, is Redfin's structure with agents who are employed, who are W-2 agents as opposed to 1099 independent contractor agents, is a significant feature of this transaction, in that one of the most difficult things to do in a traditional affiliated business arrangement with a realtor is to find ways to compensate the agents for referring to the affiliated company. You can't do that even if they're 1099s. If they're employees, there are ways that you can pay an employee for referring to an affiliate that is very different. You can't have money going back and forth between the companies, but if it's all under the same umbrella company, and it gives them the opportunities then to sort of look at the holistic package of revenues that they're getting and figure out how to compensate people appropriately.
I actually think that's a great angle here, Brian. That definitely is a interesting topic, because tie that into the NAR lawsuit too, where you have buyer agency and people are looking for lower buyer agency agreements. You can see that tie into this, where Redfin's able to offer lower buyer agency agreements because their agents are on salary. And you also tie that to what Rocket did, where, remember, they opened that real estate division where they're hiring real estate agents as loan officers, but then they closed it about a year ago. So, maybe this is a different angle for them. So how do you guys see that? Is this a play at lower buyer agency agreements? Is this a play at a reemergence of Rockets, treading into real estate and trying to get referrals over to the lender side?
I think you could see dual licensing too in certain states like Texas that allow it, where you have the same person who is they're an employee of both. You have dual employment on the Redfin side and on the Rocket Mortgage side, so it's actually the same person doing both of them potentially, and that's also an additional angle that you have to sort of be cognizant of the possibilities of. So it'll be interesting to see as it rolls out whether or not that's how they sort of contemplate doing that, or whether there's going to be a mixed model depending upon the state.
Yeah, I
Yeah,
agree with that.
it's interesting to watch and see, what angles they're going to play. Now, the consumer angle is also interesting too, because consumers have to be on board. They definitely like shopping for houses online. There's no question about that. But whether that results into the boots on the ground door opening for a consumer, that's another question. And from the lender's perspective, I could look at it like this. I've been doing residential mortgages for almost 20 years. Nobody is excited at the start of the home process to get pre-qualified for a mortgage. We try to make them as excited as possible. They're excited to walk into the house. And that's the importance of residential retail mortgage. When you look at the IMB and mortgage broker market in particular, it is a relationship-based market. And I don't see a lot of real estate agents lining up for, lower compensation or salary-based compensation agreements. Otherwise, that model would have really, really taken off. So I'm not sure how disruptive it's going to be. I definitely think this is a play at top of funnel lead management that Rocket is going to be getting more data on people, which is definitely interesting. We look at some of their business tactics of the past, like when they've done the Super Bowl pools and the Final Four brackets or the basketball brackets. They've done this stuff to get lots of consumer data, and they're very good at aggregating consumer data. So personally, I think that's the play that I think will be most disruptive. Is they're going to get earlier access to clients, but whether they can convert that is going to be a big question.
I haven't seen any data on how successful Redfin has been on the real estate side. I mean, I think of it's a good, interesting search engine, although there's several others, Zillow and Realtor.com and several others out there that when you just sort of put in the search, you're going to come up with. So I'm not sure how much that really converts to the realtor actually being involved from the Redfin side anyway. That's what's kind of interesting about it as well.
I'm not sure how well the company's done financially, but they definitely get the traction. I
Sure.
know that the disruption with Redfin is the search engine was very, very good to locate the houses. It was tied into almost every MLS in the country, and they were getting the clicks. And when you look at a property, you type in an address to a search engine, you see Realtor.com, you see Zillow, and you see Redfin. So they're in the top three, and I think that's really where the evaluation is that they're getting the consumer data and they're getting the traffic and they're getting the lead. So I'm not sure if Rocket is maybe looking at this as a loss leader, maybe. Are they not expecting this entity to make money? And they're saying, hey, this is the cheapest lead that we're ever going to get. It's definitely going to be interesting to see how they utilize it. That's for sure. But I'm not sure. Like, let's talk about one-stop shops. We've all heard of this one-stop shop concept I mean, since the first month I was in the mortgage industry, I heard about it. And I'm in the Northeast, so Wycott was always the big one-stop shop office up here. But I feel like everybody has always tried this, and very few have taken off. I'm not sure if consumers get the real estate mall concept. What are your guys' thoughts on one-stop shops and how successful those platforms are?
Well, I've seen a lot of research in the past that says that, like the Real Trends research that says consumers want a one-stop shop. Like they don't understand why, they have to get real estate here and mortgage there and title somewhere else and all these things. They just want to buy the house and want it all, sort of easily understood and packaged. There's sort of differing opinions on this as to whether you having an affiliated company, having a one-stop shop is best for the consumer. And this whole question of what's best for the consumer is sort of fraught with questions of, well, you've got conflicts of interest, or maybe you have accountability that you wouldn't otherwise have if it's one-off transactions. I think there's arguments going in both directions for that. I think there's room in the world for different business models, frankly, for
Yeah.
having a consolidated business model and for having things separate.
Brian, what I find interesting is people have asked me for years, Matt, why don't you open a real estate company? You've done so well in the mortgage industry. You've had absolute home mortgage for so many years. And, my concern has always been reputational risk. That if I went and opened a real estate company, well, if 90% of my business comes from real estate agents, how would my loan originators be affected? Would real estate agents, almost refuse to send our company business because they have an inherent fear of poaching their clients or something like that? And so that's where I think a lot of lenders, particularly independent mortgage bankers, have stayed clear of going and treading into doing what Rocket's doing. Now, in the reverse, I have seen a lot of companies go and real estate companies try to buy mortgage companies. I think that we saw this with Zillow. I think that we saw it notably with Keller Williams, and that model really did not do well. Keller was trying to give away the mortgage for free to save the 6% real estate commission. I don't think that fared well for that corporation. They learned very quickly that running a real estate company and a mortgage company is two different things. But look at this transaction again. Redfin bought Bay Equity, and I don't think that Bay Equity was after the acquisition they were profiting on that as well. So I'm not sure about this one-stop model. I'll be a
Marty, do
skeptic
you?
on it once again.
It's interesting you mentioned that that consumers really want it, and I think in some ways they like the convenience of it, but I don't know that they fully trust it. I think that's been one of the issues, and that we've seen that even in a affiliated business that it seems to work, where you have the builder operating a mortgage company and title company and other things. They have to incentivize in many instances the borrower to use the affiliated companies in many instances, because borrowers on the other hand kind of like being able to bounce ideas off of someone who isn't the same as the builder from time to time. And so I think that's the kind of the yin and yang of it a little bit, is they like the convenience of it, but they still like the sort of the sanity check by someone who isn't necessarily directly affiliated. Although, in many instances, the real estate agent, if the borrower is represented by one, it does get a lot of business through that builder in many instances. So they're still tied to it, even if they're not a direct employee in many instances. So it's a little bit more of a difficult sort of scenario to fully get an answer one way or the other as to do they want one or not, because I do think they like that sanity check of having someone outside the builder from time to time.
I think that builder relationship is the perfect example. You look at a builder where you have a captive audience,
Right.
and they still have to offer, free granite countertops, and upgraded fireplaces and incentives to actually use the in-house lender. That kind of shows you that, the consumer still has well, I have a person type mindset. And they still really rely on the real estate agent's recommendation as well. So I think this is really going to be dependent on how successful Redfin's real estate call it quote unquote consumer direct model is still going to maintain, and if their real estate agents can actually convert. Now, Rocket is very, very good at issuing very competitive loan estimates. So, there's another angle of disruption here that we can see. Let's tie this into some regulation. Gentlemen, we know, even though the CFPB is being diminished a little bit, we still have MLO comp. We cannot adjust our compensation. We do not have demonstratable price competition. So if Rocket Mortgage is throwing LEs out at the top of the funnel and get these people to apply, will that actually cause disruption in the retail sector, where typically they've caused disruption in refinance? Is that going to cause disruption for IMBs and brokers that are now competing with lower loan estimates?
Well, I think it definitely starts the conversation differently than you would otherwise if the borrower already has that in hand, for sure, in terms of that. Now, the question is obviously service and other things that you have along with that, or whether or not they're being steered to the right program. Is there some opportunities elsewhere that someone who is a more schooled loan officer on the IMB side or a bank affiliated side or something like that may be able to offer? And so that it's going to change that conversation to some extent, for sure. One thing that's interesting to me about all of that too is that the savings on the real estate side for Redfin are really usually inure to the benefit of the seller, not the borrower. And so how does that going to impact the negotiations and other things with respect to that? So that'll be also something interesting to
Well,
watch.
the seller's got to go someplace, right?
Yep,
And right, are they going to
that's true.
capture on that side? But that's what I was talking about the NAR lawsuit earlier.
Right.
Is this a play where the salary-based real estate model really comes into play? Is buyer agency in the NAR lawsuit, which is surprising to me because going back 6 to 10 months ago, last August, we thought that the buyer agency was going to be the biggest disruption in the market and that all these buyers were going to be negotiating lower buyer agency compensation. And it wound up being almost a nothing burger. We wound up seeing that sellers are still paying 5, sometimes 6%, and still
Yep.
covering the buyer agent compensation. And buyers are largely not negotiating. But hold on for a second. If a player comes out and starts saying, hey, we'll represent you for 1%, pocket the 2%, but use our mortgage company. I don't know
Yeah.
the regulatory implications for that. Again, you're under one umbrella here, but does that start saying, well, if I go and use this agent, I'm going to get 2% off. If a seller's offering a 3% buyer agency compensation and Redfin will do it for 1 and buyer agency, they'll sign a contract with me like that. Could that offer a competitive advantage for people using them as buyers and tread into that direction?
Yeah, I think
Sure.
look,
Go ahead, Brian.
there's going to be a lot of disruption, I think, in the real estate industry as a result of the sort of the decline of the MLS control and this NAR settlement. They're just there's just too much technology out there to enable people to shop online for houses, and there's the, the value that's provided by realtors is changing. And they need to be able to articulate that value. And again, I've said this before that I think they do provide a very important function in terms of education, in terms of handholding in the process, understanding negotiation, marketing and sales, and pricing. Those are all very important pieces of information, but a lot of it can be done on the internet without human interaction. And I think that's where realtors are going to have to differentiate themselves. And I think you're also seeing just a lot of consolidation now because I think the economics are changing, and this consolidation allows for other sources of revenue to support these features. It doesn't have to be the case that there's a real estate sales person and a mortgage person and a title person. That's the way historically we've done it, but it doesn't have to be that way. There's nothing in the law that says that, there's nothing in the Constitution that says this is the way houses are supposed to be bought and sold. And I think we're
The
seeing a lot of
housing
change.
constitution.
Yeah. Well, it may be disruptive for every piece of the industry. I mean, I
Sure.
think we all have to be aware that I mean, certainly you look at what's happening in Washington right now and you say, wow, I never envisioned that, the CFPB could be just, decimated in this way but then 15 years ago, we didn't even have the CFPB. So
Sure.
things change.
Well, if there's one thing that our industry is used to, and even the greater real estate industry as a whole, is disruption and pendulum swings. I remember in the early 2000s when automated underwriting came out, and they said we're never going to need an underwriter again because AUS engines came out. Well, we learned very quickly that wasn't real, and I remember when the online Zillow first came out and the MLSs came out. If you remember, somebody used to schedule an appointment to go into a real estate office and flip through an MLS book. That was the only, and you
Great.
used to get Home Shopper magazine out of the out of the front of the cabinet at the diner before you went in for a meal. We thought all of this stuff was going to be so disruptive, but what we've learned more than anything is the consumer does like relationship management. So, to close out that segment, that's what I'm going to hang my hat on is that consumers like relationship management. I think that Brian, you hit the nail on the head. Real estate agents offer a lot of value, and one of the biggest pieces I think they offer is quarterbacking the transaction. the emotional quarterbacking of it is very, very important because just emotions run high when it comes to people's homes. Any final commentary? If not, I'm going to introduce a new topic.
I think move on to the next topic, I think. Sounds good.
All right, so let's talk a little bit about some regulatory. This is Regulation Central, right? I want to talk a little bit about CFPB and in particular CRA for IMBs. We know that, as Brian was just saying, the CFPB is being minimized on the federal level, but what that leaves is a vacuum. We saw in the past 12 to 18 months, I think, an uptick in fair lending, in redlining cases from the CFPB. We saw the guards go up of a lot of IMBs. A couple of notably really large lawsuits were handed down to the tune of tens of millions of dollars of corrective action on fair lending cases. And now, in the absence of what looks like federal oversight, I think it's going to fall back on the states. So we've heard of states doing CRA, Community Reinvestment Act, for IMBs notably. And I'll just introduce what the problem is from, I guess, MBA's perspective is that independent mortgage bankers are non-depository institutions. We don't hold deposits. There's nothing to reinvest in the community. We're not taking money in. The initial intention of CRA was depository branch locations inside of inner cities, taking money in from the community and lending it outside of the community. And the disruption that a lot of the industry has seen, or a lot of what the barking has been gone on with CRA for independent mortgage bankers in particular, is saying we're not holding deposits, so there's nothing to reinvest. And IMBs already serve the underserved communities. So you have a couple of states. If you guys want to go run down what you think is going on. I know New York is a notable state with some recent traction. What are your thoughts on CRA for IMBs and how there may be a state uptick in the wake of CFPB?
Yeah, so
I know,
Marty, you can jump in.
right. Okay, I'm sorry. I know Illinois is another state that also had the CRA statute that they put into place as well with respect to it. My personal view is it's just completely wrong-headed. Again, for the reasons that you stated and that the MBA has kind of put forth, is that if you look at community reinvestment, you got to have deposits first, and the idea that the IMBs don't is sort of kind of the beginning and the end of the analysis as far as I'm concerned. The second piece of it, though, is really also that I think they focus entirely on stuff that is archaic. They look at things like where your branch location is. With an IMB, it matters very little where I put my branch because, frankly, in many instances, loan officers barely come into the branch anymore at all today. It's much more of an internet-based and less geographically centered around where the office is when you look at where the originations actually come from. So I just think it's kind of wrong-headed, partly because of that, but partly because they use anachronistic analysis from back in the 1960s and 70s when they were doing CRA for banks, and when they were looking at those requirements and the fair lending aspects of that. Where branch locations are and where loan officers are hired from doesn't matter as much. Most loan officers I know will take a deal wherever they happen to get it. Now, does that say that they're serving every community the same? No, they're probably not. I think that you do have certain neighborhoods where it is more difficult to get a loan, and so the loan officers are naturally going to gravitate where it's an easier job for them to get the loan approved than in certain others. And so I think that's sort of naturally there. And that is the concern, though, of the regulator with respect to it. But where I struggle with it is just the analysis as a whole doesn't make a lot of sense to me as it relates to IMBs. Brian, I'll let you sort of jump in there and tell us your thoughts as well.
Yeah, I agree with everything you just said. But I want to add that the CFPB and the Justice Department, in how they've been enforcing fair lending in terms of the reverse redlining cases, the consent orders, and those types of things, essentially was looking at fair lending as if it was CRA. In that, that your failure to encourage lending was somehow discouraging lending. So you look at that and you say, well, okay, it's a Townstone, kind of got as far as it got. What's the status of fair lending now in terms of, first of all, how will it be enforced? Certainly, I don't expect it'll be enforced as it has been over the past 4 or 5 years. I think you're going to see, and then I think you also have to couple that with this idea from the Harvard admissions case that you can't use race to, to make these kinds of determinations. How are these states looking at this, and is that going to be challenged under that same standard? Disparate impact being the idea that your failure to have comparable lending patterns with your peers is somehow evidence of discrimination. It may be, but it also may not be. And I'm not sure how that's going to be used going forward. I think these state CRA type requirements on IMBs have a lot of it's a very different world now that they have to be supported in, and I think they're very open to challenge, particularly on that Harvard admissions kind of basis, because basically what they are is they're reverse redlining statutes, right? They're making you have to go out and lend in a diverse way, and I'm not sure that that's supportable anymore under constitutional law.
I think it's
Yeah,
also problematic with the ability to repay rules. On the one hand, you say we want you to look very carefully at the borrower's ability to repay, but we also want you to very carefully try to serve these underserved communities. And there's some tension between those two concepts that lenders have to sort of navigate. And I think that makes that particularly treacherous in this environment that we've sort of come from, where redlining and reverse redlining was such the rage, because again, I just think it was sort of somewhat misplaced in terms of how it was being applied.
Well, considering I'm an IMB, I'll jump on my soapbox for a second here. I think it's ridiculous. We take every single loan that we can get. We are hitting the streets nonstop. Our loan officers are constantly looking for referrals. This is what they do on a daily basis. They are not really showing up to offices as much anymore. They are on the street and being movers and shakers, especially the retail loan originator. And, we are never looking at a loan for reasons why to deny it. We're looking at, it's so hard to get a referral. You're looking at every which way to get that borrower qualified. To the point that we're leveraging every single program known to man. And, the inventory shortages is something that we have abstainably no control over that are inside of these communities. And a lot of times we have qualified buyers. We have borrowers from these areas. And, because they are limited down payment or potentially using down payment assistance programs, we have probably more of an issue with getting sellers to accept offers in the competitive real estate market. And also some areas we have problems with gentrification that, the communities, the underpriced communities are seeing other buyers come into them. It's getting a little sickening that we're constantly looked at as the bad guy, and particularly when the data reflects that the independent mortgage banker community is the community that stepped in place of the banks over the past 15 years. And we are predominantly doing the lion's share of underserved borrower originations by a vast majority. I believe the numbers are in the 70% plus range of residential mortgage originations in underserved areas. So for me, it's always been a troublesome topic, because I do think that originators and independent mortgage bankers do have the consumer's best interest at heart, and they're trying to close loans.
I think banks have also figured out they can often cherry pick some CRA loans from the IMBs in terms of buying them. They often will buy those as their time is sort of running out in terms of the reporting period, pay perhaps a premium for it. And that's just less expensive acquisition of that CRA loan for their own data than it is for them to originate it themselves, which is another role that, as you say, IMBs are really playing, because I think it skews the data even more in the IMB's favor with respect to that.
I definitely see that. I think we see price incentives for CRAs from the bigger aggregators and the bigger depository institutions saying, "Hey, we'll pay up for mortgages in these certain MSA codes because they're trying to fill their buckets. Now there's a bigger question is, does that go away, right? Because the depositories, do depositories, maybe you guys can answer this question. I don't know. Do depositories answer to states or are they only answering to federal? So, and they weren't answering to CFPB either. So does this affect, since the state regulators are looking at IMBs, is there any effect on federal depositories for CRA now?
I don't think that the state piece of it really impacts the federal, just because the regulatory scheme is different for the two. I think the real issue from the IMB side is just borrowing the concepts from the federal side when they really don't have any place in it, based upon the way IMBs operate for the reasons that we've kind of talked about today.
Yeah, CRA is a federal law, congressionally approved law, so it applies to all federally insured banks. And then credit unions have their own kind of a thing. But one thing to keep in mind here also is, states can be more restrictive than the federal
Sure.
standard. I mean, and they can do other things if they want. I just think that they need to be careful in terms of not overplaying something that is going to be viewed as unconstitutional under current jurisprudence.
Yeah, I agree. And, I'll dig in a little bit deeper on the topic. I remember I was at an Armor conference about 2 years ago, and William Cooper from MBA gave an amazing presentation to state regulators. And he had shown data from Massachusetts that actually showed that after the implementation of CRA, originations actually went down inside of the state. And I was like taken back by that. And he gave such a compelling argument about it. And, going back to the CFPB, kind of being diminished in a certain form, I think that CSBS is the new queen of the ball here, that Conference of State Banking Supervisors, these conferences where the regulators come together under their guidance organization. I'd be interested in the topics that they're going to start having over this, because it seems like some states are just ignoring what the data shows and they're saying, well, we're doing it anyway. New York has been leading the charge with pushing a lot of stuff through. We've seen most recently February 5th, 2025, New York DFS officially published its proposed CRA regulations after what felt like years of debate. They put that on the state register. So some states are trooping through. We saw in January, Pennsylvania reintroduce the legislation. And then we also saw February 5th as well, Maryland introduced it, but it was withdrawn by the sponsor. So you are seeing certain states, still tread forward with this.
Yeah. Well, I think you're going to continue to see fair lending sort of proposals there. The CRA aspect of it is the aspect of it that I sort of challenge the efficacy of, because it doesn't make sense to me. But fair lending, I strongly believe in. But I also understand that marginally qualified applicants today run a greater risk than they've run in a long, long time because of unknown sort of expenses related to increases in insurance, increases in taxes, and other things that cause what might have been a borrower who would be marginally able to perform in the past to have a much more likelihood of failure going forward. And I think that our fair lending lens needs to somewhat reflect that, because at some point, as servicers and others, and as we originate mortgages, we have to be mindful of, if that mortgage doesn't perform, that's a black eye on the industry and not really helpful to the borrower at the end of the day.
Yeah,
I agree. So let's close out that topic, and we only have a couple minutes left here. Let's talk about, since we're on this topic of federal regulations, we've had some appointments go through since the last time we met. So we saw Bill, is it Plute? Pulte, excuse me,
Yep.
Sorry.
Yep.
So Bill Pulte, he got appointed director of FHFA, and this week, did you see what he did this week? I think he wiped out the GSE's board of directors, right?
Well, maybe not wiped them out, but he certainly restacked it. That's for sure. We saw several folks that came off of both Fannie and Freddie boards, and new people went on. So that's going to be interesting to see how that plays out. there was several things that were interesting to me about it. Usually when you see these kind of board announcements, they're very, very carefully orchestrated, that you kind of see the new bios of the people that come on, and you see effusive thanks for the people who have been serving that are going off. Well, that was not at all the way this was handled. What you saw was just a very truncated announcement of what happened. In fact, some of the people, we weren't quite sure who they were, whether we had the right person when we looked at it, but it was, so that was kind of interesting. But I think that a few things were noteworthy. Several of the appointees are very young, meaning that they're 30, 35 years old, as opposed to typically someone on a board with the magnitude of Fannie Mae or Freddie Mac would be someone in their 50s and 60s, maybe late 40s at the earliest. So you saw a dramatically younger group. Now, Bill Pulte is also very young. Pulte Homes this is the grandson of the guy who founded Pulte Homes. His dad also operates a luxury home builder in South Florida. So he's been in the mortgage and building sector for a long time, kind of grew up in it, understands that. Actually, he served on the Pulte Homes board of directors as well prior to it. But so it's going to be interesting to see. But you've definitely got younger folks on. You have one guy who is actually X is where he works, and is in charge of cybersecurity for X, and he's been there for just a few years. He graduated from undergrad in the last decade or so. So just really young folks. So you're definitely going to have people who are going to be a lot less sort of mainstream and a little bit more bold probably in their approach, which is certainly what I think the administration looks for here. I think one thing that they probably avoided by doing the appointments early is you don't have to worry about making a proposal and the board resigning en masse as a result of them not liking the proposal. So I think that there is some probably political reasons that they have done this the way that they have. But again, I was a little struck.
Ex-appointee feels like it has Doge written all over it, right?
Yeah, he works for Doge. He works for Doge,
Yeah.
actually. He's on Doge's side right now. He's part of the Doge thing. So you have someone from Doge who's actually going to be on the board of Fannie with respect to it. So that was rather interesting. One of the people who left the board was a guy who won the Nobel Prize for economics last year. So you look at just the dynamics of the, just the on paper qualifications of the people, and it's pretty striking what you see. Brian, what was your response when you saw that this morning or yesterday?
Yeah, I think it's very Doge-like, this move. And I think what we're seeing is this idea that, they want to put people in place that don't have the kind of preconceived notions about how things are supposed to operate. Been in the industry for over 30 years. There's certain things I just assume Fannie and Freddie are always there, until, then you have the black swan event, and then you realize, wait, maybe they won't be there.
Right.
So I think the people coming in, they're trying to, not all of them, because they kept some people with institutional knowledge, which I think is really important. But I think also, those sort of fundamental questions that you might never ask, those might get asked. Like, I don't know, why do we care about credit scores? Somebody asked that question, let's re-ask that question. We might assume we know the answer, but a 30-year-old cybersecurity expert might say, why is that important?
Well, you know what? We're not going to open that can of worms with 3 or 4 minutes left. Why do we care?
No, I'm just, my point is that we're there, the kind of, I think this is happening at CFPB too. I think, the kind of questions is sort of getting down to the foundations again, and then rebuilding these institutions. I mean, culturally, there's been a lot of malaise in the federal institutions, and then Fannie and Freddie would be counted in that category. They've got these cultures, they've built them over time, and they're very hard to change. CFPB was built, Elizabeth Warren and that group, and that culture was what, frankly, frustrated a lot of people in the mortgage industry. This culture of combativeness with the industry instead of cooperation to create a better market, focus on equity and vulnerable communities instead of sort of expanding the market and raising the tide for all ships. I think those things are tough to change, and you have to start at the top, and you have to strip quite a bit out. I wouldn't do it that way. I wouldn't have the guts to kind of do it this way. Be more incremental in my approach, and but I'm not in charge.
I think the restacking of the board here, though, does increase the likelihood that you see the agency's exit conservatorship. I do think that this is the kind of bold move at the top that will, and I think that's ultimately what this administration would like to see happen. I think the real question is going to be what happens with the implicit or explicit government guarantee with respect to that. There's also some things that I think that they could do fairly quickly to lower the cost of mortgages, and that they may be prepared to do, and maybe that has to do with loan level price adjustments, at least as it relates to purchase money or owner occupied properties. Those are things that they could probably adjust some out and actually lower cost of mortgages pretty immediately. So I think you may see some movements there that they would want to do, and that the alteration of the board of directors makes that a little bit easier to accomplish.
Well,
One
I'll tell
thing
you
I
what,
think you're
one,
go ahead, Matt.
okay, Brian.
No, I was just saying, one thing I think you're definitely going to see is shrinking of the size and scope of those institutions. They're not going to be doing as much.
Well, one thing that I saw
Bare essentials.
that I really liked this week was he put out an announcement. One of his first orders of business was a feedback. Said, "Hey, what's going on, Freddie and Fannie industry? What do you want to see changed?" And anytime I see an oversight regulator going and looking for people on the street level to start providing feedback, that for me, I welcome that type of leadership. Well, to finish up, we had another appointee I wanted to talk about, so we're not going to have time today, but I just want to throw major props and a shout out to Matt Jones. He was recently appointed the FHA Deputy Director. So this is a huge appointment. Matt Jones came from MBA, worked on the policy administration's team, Pete Mills' team for many years, is a good friend of mine, and definitely one of the most brilliant individuals I've ever met for regulatory housing policy in the industry. So I think he's going to do a phenomenal job. I think that's going to open up a lot of inroads to have engaging conversations for our industry. So I definitely want to congratulate Matt Jones on that as well. And with that, I also have to once again thank Polunsky, Beitel and Green, our sponsor today, mortgagelaw.com. Check it out for all of those legal documentation needs if you're in the mortgage industry and you're a lender. And I want to thank Marty and Brian, our amazing panelists. Thank you again, gentlemen. I look forward to next month's presentation, and we'll definitely have some more engaging topics.
Sounds great.
Thank you,
Thanks,
Matt. Thanks, Marty.
Thanks, guys. Appreciate it.